Hi everyone, welcome back. This is Andrew Jordan with NodeWise CPA. If you run a managed service provider, S corporations come up a lot because payroll tax savings can be meaningful once profits start to stabilize. In this video, we're going to talk about S corporations. They're one of the most popular structures for small and mid-sized businesses, and for good reasons. But there are also some important details people tend to overlook, and if you don't know about them, then they can come back to bite you. Start with our disclaimer. This video is for educational purposes only. It's not tax or legal advice. Every business is different. You need to talk with your own professional about what makes sense for your specific situation. All right, let's dive in. The biggest reason business owners choose S corporations is because they get payroll tax savings. Here's how this works. As an S corporation owner, you split your income into two parts: a salary you pay yourself for the work you do, and distributions you take as the business owner. You pay payroll taxes on the salary, but not on the distributions. If it's set up correctly, this can save you thousands of dollars each year in self-employment tax. But here's the key. The IRS requires that your salary be reasonable. That means it has to make sense for the work you actually perform, your industry, your experience, and the time you spend in the business. It's not about picking a percentage of profit or using the Social Security wage base. All those rules of thumb you hear about online aren't supported by IRS guidance and can attract audit risk. Reasonable compensation is based on facts and circumstances. There's literally no formulas the IRS has said work. So it's important to document how you arrived at your salary using market data, comparable roles, and a clear rationale. Keep that documentation in your corporate records. At our firm, we actually license a specialized tool to help clients calculate reasonable compensation. It uses industry data, job responsibilities, and company details to generate a documented report showing how their number was determined. One more big point: you have to actually run real payroll. This is where MSP owners sometimes get sloppy, especially when cash flow fluctuates or projects run long. That means regular paychecks, quarterly filings, and timely deposits of payroll tax. You can't just skip payroll all year, then issue yourself a lump sum W-2 or 1099 in January. The IRS doesn't consider that proper compensation. Catch-up payments for prior years usually won't fix the problem, especially if payroll tax deadlines have passed. What if you own multiple S corporations? Each S corporation stands on its own. The IRS expects you to evaluate reasonable compensation separately for each company, based on your role and the services you provide to that specific business. You can't just pay yourself from one entity and then ignore payroll in the others. A few pitfalls to keep in mind. First, loss limitations. If your S corporation has a loss, you can only deduct it on your personal return if you have enough basis. Essentially, it's what you've invested in the company plus any retained earnings. If you don't have enough basis, those losses get suspended until you build it back up. Second, compliance. An S corporation comes with more administrative work than a sole proprietorship or a single member LLC. You've got to run payroll, file quarterly payroll reports, file more complex tax returns, and keep up with corporate rules in some cases. That's part of the trade-off for the tax savings. There are a bunch of other things to consider that we don't have time to get into in this video necessarily, like you generally don't want to own real estate in an S corporation. There's a big impact if you have a SEP retirement plan, impact on inheritance, and some other things like that. So when does an S corporation make sense? Usually once your business is consistently profitable and you're taking home more than you'd reasonably have to pay yourself in salary. At that point, the payroll tax savings can justify the added complexity. If you're just starting out or your income is still unpredictable, it might be better to let things wait until they're more stable. Let's recap. The main benefit is payroll tax savings through the salary distribution split. And just to give you an idea, this is usually in the like $5,000 to $10,000 in tax savings per year range. You must pay yourself a reasonable, well-documented salary. That's not negotiable. You need to run real payroll and stay compliant with filing deadlines. We can help clients calculate and document reasonable compensation. We use a specialized tool backed by industry data. Retirement contributions can be optimized with intentional planning. Be aware of pitfalls like basis limitations on losses and the additional compliance burden. All right, that's it for today's video about S corporations. Next time, we're going to wrap up this series with a potpourri of unique strategies, things like medical reimbursement arrangements through a C corporation, Puerto Rico tax incentives, and captive insurance companies. These are not for everyone, but in the right situation, they can be powerful tools. And remember, if you're a client and you want to explore S corporation planning in more detail, let's talk about it. If you're not a client, but you're running a successful business and you want to see how we might be able to help you, feel free to reach out. Thanks for watching, and I'll see you in the next video.